All right, so a little bit of a history on Jerome Powell, a little bit of a background, and to commemorate this final FOMC meeting with Jerome Powell as the chair. May 15th is the term end date, and seems like Powell isn't too opposed to the Kevin Warsh nomination and the new Fed chair incoming. He's going to remain as a Fed governor. He doesn't want to be a shadow federal chair, so he's looking to really continue the work that he's doing, except without notoriety. Well, I forget the way he said it, but he's going to be on the sidelines. So Jerome Powell and the Federal Reserve, the man before the chair. Jerome Powell was born on February 4th, 1953 in Washington, D.C. He went to Princeton University for politics in 1975, Georgetown University Law Center in 1979, where he served as an editor-in-chief of the Georgetown Law Journal. After Princeton, he had, by his own account, no plan and no job. He spent 6 months putting labels on shelves in a warehouse before law school, and he later called it exactly what he needed. As a corporate lawyer in New York, an investment banker at Dillon and Reed Co., 1984 to 1990, and under Secretary for Domestic Finance, U.S. Secretary under President George H.W. Bush, 1990 to 1993. Responsible for debt management and financial institutions and treasury markets. He was a partner at the Carlyle Group from 1997 to 2005, founded Severn Capital Partners, a boutique private equity firm, in 2005, visiting scholar at the Bipartisan Policy Center in 2010 and 12. Every Fed chair since Alan Greenspan in 1987 has held a doctorate in economics. Powell does not. He's the only practicing lawyer and private equity executive to lead the Federal Reserve in the modern era. Appointment to the Federal Reserve Board of Governors, appointed by President Barack Obama, May 25th, 2012, as a Federal Reserve Board as a governor, which he's now coming back into. Filing an unexpired term, the nomination was the first since 1988 that President nominated a member of the opposition party to the board. Since Obama was a Democrat, Jerome Powell is more aligned with the center-right, mid-right. He's more of a Republican capitalist. Obviously, he's head of the chair Federal Reserve. Anyways, reappointed and sworn in June 16, 2014, and through the mid-2010s, Powell built a reputation as a consensus builder and pragmatic centrist, supporting post-2008 recovery policies while generally favoring gradual normalization. And his elevation to the chair was nominated by President Donald Trump, November 2nd, 2017, during the first term, sworn in as the 16th chair of the Federal Reserve, February 5th, 2018, succeeding Janet Yellen. At the time of his appointment, Powell was the wealthiest Fed chair since the 1940s, with a reported net worth between $19.7 million and $55 million. He inherited an economy in its, actually 104th-ish consecutive month of expansion, the longest in recorded U.S. history, with unemployment at 50-year lows and inflation running just below 2%. So in 2018 to 19, the normalization of the Fed, Powell pivot. Powell continued the rate normalization path that was begun under Yellen, raising rates in 2018, and as the economy had expanded. And by December 2018, markets had sold off sharply, with the S&P 500 down approximately 20% peak to trough. Early 2019, Powell signaled a pause in the hiking cycle, a shift that markets and commentators immediately labeled the Powell pivot, demonstrating his willingness to reverse course under financial stress. The Fed cut rates 3 times in 2019 in response to trade war uncertainty and slowing global growth. And throughout this period, Trump publicly and repeatedly attacked Powell for raising rates, arguing moves would slow economic growth. And in July 2018, Trump had also stated in a CNBC interview that he was not thrilled with the Fed's rate increases. He's never been an advocate for increasing rate cuts ever, or increasing the interest rates. In January 2019, Powell publicly stated that he would not resign if asked to do so by the president, which he was. February 2019, Bloomberg reported that the Office of the White House Counsel examined whether Trump could legally remove Powell. Powell's consistent response is that, "I think the law is clear and I have a 4-year term and I intend to serve it." Okay. And then moving into the COVID-19 crisis response, March 2020, which is one of the next big crises, and probably the biggest one that we've dealt with under these 2 terms. U.S. economy entered the sharpest contraction on record. Real GDP per capita fell at an annualized rate of negative 24.7% by Q2 of 2020, compared to negative 3.7% annual rate during the Great Recession, 2009 to 2016-ish. Employment reached 14.7% April 2020. The Federal Reserve's response was the most forceful in its history, and on March 3rd and March 15th, 2020, the Fed cut the federal funds rate by a combined 1.5 percentage points to a target range of 0% to 0.25%, which doesn't happen often when you get the 0% interest rates, which is also creates other problems down the line, but I'm not getting into that. 9 emergency lending facilities were established in under 3 weeks, including the corporate credit facilities, the Main Street Lending Program, the Municipal Liquidity Facility, and the Paycheck Protection Program Liquidity Facility. And finally, the Primary Dealer Credit Facility. The Fed's balance sheet surpassed its prior all-time highs of $4.5 trillion by March 2020, and it exceeded $7 trillion by May. Powell at the Brookings Institution in April 2020, 6 years ago to the day. "We were deploying these lending powers to an unprecedented extent and will continue to use these powers forcefully, proactively, and aggressively until we are confident that we are solidly on the road to recovery." In Powell in May 2020 speech, he also drew a critical institutional boundary. The Fed has lending powers, not spending powers. As well as he said, "This downturn is different from those that came before it. The virus is the cause, not the usual suspects." The combined peak in emergency facility balances reached just above $200 billion in July 2020. Markets stabilized rapidly. The crisis-era facilities widely credited with preventing the liquidity crisis from becoming a solvency catastrophe. And then the flexible average inflation targeting, FATE, August of 2020. At the Jackson Hole Symposium in August 2020, Powell announced the adoption of the flexible average inflation targeting, or FAIT. The new framework allowed inflation to run moderately above 2% for some time following the periods in which it had run below that level, and explicitly tied liftoff to from zero rates to achieving broad-based maximum employment. This was a structural shift in the Fed thinking, and acknowledgement that the prior decade's persistent undershooting of the inflation target had left workers, particularly those at the lower end of the income spectrum, with less than the labor market could deliver under a more accommodative stance. The transitory inflation judgment and its consequences in 2021, as the economy reopened and pandemic-era fiscal stimulus flowed through the system, inflation began rising sharply. Throughout much of 2021, Powell and the Fed characterized the inflation as transitory, driven by supply chain bottlenecks, good sector disruptions, and base effects that were expected to resolve without requiring monetary policy response. And in a 60 Minutes interview in February 24, Powell addressed this directly. He said, "In hindsight, it would have been better to have tightened policy earlier. We saw that we thought was inflation mostly limited to the goods sector and the supply chain story. We thought the economy was so dynamic that it would fix itself fairly quickly. That was a very widely held view of economists around the world, and the data were kind of friendly to that assessment right up to the point when they weren't." And by the fourth quarter of 21, it was clear that the inflation was not transitory. At the November 21 FOMC meeting, the Fed announced a phase-out of asset purchases. At the December meeting, the taper pace was doubled, and over the period of the pandemic-era purchases, the Fed securities holdings had increased by $4.6 trillion. In October 2025, at an NABE speech, Powell offered a more precise formulation on the same admission. He said, with the clarity of hindsight, we could have and perhaps should have stopped asset purchases sooner. Our real-time decisions were intended to serve as insurance against downside risks. And then now, 22 to 23, the tightening cycle. The Fed began its rate hike cycle on March 17, 22, raising rates by 25 basis points. The US CPI peaked at 9.1% year over year in July 22, the highest rating since 1981. The Fed proceeded to hike rates 11 times through July 23, and raising the benchmark rate by a cumulative 5.25 percentage points from near zero to 5.2 to 5.5%. This is the most aggressive tightening cycle since Paul Volcker in the early 1980s. In a 2022 press conference in July, Powell said, "My colleagues and I are acutely aware of that high inflation imposes significant hardship, especially on those least able to meet the higher costs of essentials like food, housing, and transportation. We are strongly committed to returning inflation to our 2% goal." The consequence of the speed and magnitude of the tightening were significant. In March 2023, the Silicon Valley Bank, Signature Bank, and the First Republic all failed in rapid succession, each having accumulated large portfolios of long-duration Treasury securities that had declined sharply in market value as rates rose. The three failures represented the largest concentration of bank collapses in a single period since 2008. The Fed's emergency response, expanding its balance sheet through lending facilities to contain contagion, was widely credited with preventing broader systemic stress. Trump would never acknowledge that. Anyway, Powell ran the most aggressive tightening cycle in 4 decades without triggering a deep recession. Whether that constitutes a soft landing or a delayed reckoning remains one of the contested empirical questions of his tenure. So, in the final months from 2024 to 26, by mid-24, inflation had declined significantly toward the 2% price target, which turned out not to be so transitory. It took 3 years. Though consumer confidence remained subdued, Powell noted in a public statement, "It will be some time before people regain their confidence." The Fed began a cautious easing cycle, cutting rates in September 24 for the first time since the pandemic emergency and signaling a data-dependent path, which they followed until today. Powell's final FOMC meeting today, April 29th. He closed his tenure with the federal funds rate at 3.5 to 3.75% and headline inflation running at approximately 3.3%. I'll add in that true inflation is, I'll have to check the true inflation. It's around 1 point some percent though. So I like the true inflation statistics. It's a little bit less convoluted. Anyway, the Fed's balance sheet stands at 6.7 trillion now. So across Jerome Powell's tenure, Powell faced sustained political pressure from both directions. Trump has criticized Powell publicly for raising rates during his first term and again during his second presidential term, and for not cutting rates fast enough. In January 26, Trump announced the nomination of Kevin Warsh as Powell's successor, and the DOJ opened an investigation into Powell, which was later handed to the Fed's Inspector General without charges. And in response, Fed former chairs Greenspan, Bernanke, Yellen, along with the former Treasury secretaries and senior economists, issued a joint statement calling the investigation an unprecedented attempt to use prosecutorial attacks to undermine the Federal Reserve's independence, which is the whole point of the Federal Reserve, to be independent from the government and to be independent from political objectives and focusing on economic ones. And that's what really matters, actually, for most people. Most people don't care about anything but economic objectives. Janet Yellen stated publicly that Trump's demands for the Fed to cut rates to lower the national debt's interest burden is the road to a banana republic. We don't want that. There's examples of that in other places, which we're not getting into. Powell's own response to the sustained pressure over 8 years was consistent. He did not cut rates under political pressure. He did not resign when asked, and he did not yield on institutional independence. His term as chair concludes May 15th, 2026. His separate term as board governor runs to January 28th, and as of the date of this, he has not publicly confirmed whether he would remain. But he will remain until 28. He did say today he plans to stay on as he actually said, I will continue to serve as governor for a period of time to be determined, which I would assume is going to be until that January 2028. Okay. And so Jerome Powell's 8 years encompassed the largest balance sheet in the institution's history, with the worst inflation in 4 decades, the fastest tightening cycle in a generation, and 3 bank failures inside 10 days. He admitted the decisions that were wrong. He defended the ones that he believed were right, and through sustained political pressure from 2 presidents of opposing parties, he never compromised the independence of the institution he was entrusted to lead. Jerome Powell's and the Federal Reserve's effectiveness depends on one principle above all, that its decisions are made out of the basis of data and mandate, not political instruction. And Jerome Powell held the line every time. And in April 2020, Jerome Powell said, "We are deploying these lending powers to an unprecedented extent and will continue to use these powers forcefully, proactively, and aggressively till we are confident that we are solidly on the road to recovery." And in the next month, he said, the Fed has lending powers, not spending powers. In July 22, Jerome Powell said, "We are strongly committed to returning inflation to our 2% goal. We will keep at it until the job is done." In the same month, he said, "My colleagues and I are actively aware of high inflation imposes significant hardship, especially on those least able to meet the higher costs of essentials like food, housing, and transportation." Okay. And then today, the FOMC stated that they have decided to leave our policy rate unchanged. We see the current state of the monetary policy as appropriate to promote progress toward our maximum employment and 2% inflation goals. And also, Jerome Powell mentioned today that the US economy is the envy of the world, which is pretty much the culmination of all the work that they've done within the Federal Reserve over the past 8, 9, 10 years. And so history will account for the rest and what comes next. So thank you, Jerome Powell, for all the work you've done, for actually sticking to the plan, holding down for the ones who actually care about economic certainty and beneficiality for the whole of our people, Americans within the country. And with the independence of the Fed to remain steadfast in decision making, even under pressure. I'm sure it's not an easy thing to do. And Jerome Powell might have been the best guy for the job. Now we're going to have Kevin Warsh. We have a warm welcome for Kevin Warsh coming in. There's really a lot to get into there. I'll do that another time. And I'm still doing some research on Kevin Warsh. But I think Jerome Powell seems to be somewhat accepting, maybe not approving fully, but accepting of it. And I think that's a good thing for us to lead off on. So that's it. The final Federal Open Market Committee meeting, press conference with Jerome Powell as the chair of the Federal Reserve, April 29th, 2026. He's not going anywhere. We just won't hear directly from him as much. Not during the meetings. We're going to be hearing some new information, some new opinions, some new takes, but he will still have a say in what the Federal Reserve is doing. And given that his tenure has been quite successful, given all the crises and all the different pressures that has been led upon him, now I think there's room for a massive growth, massive expansion in our economy that we haven't seen since the likes of before COVID took a bit of a crap on that progress that we were making. And the credit, the private credit, the private equity investments into our economy right now with data centers and with technology like artificial intelligence and automations and robotics and energy development and all these new programs that are supposed to help keep the economy stable while we're doing all this spending on all these new technologies. Just like back in the late 1800s with railroads, we spent tons of money on developing railroads and developing the infrastructure, which ended up failing, but later on was a blessing in disguise, because that infrastructure that was created during the time of expansion and during the time of excessive spending and speculative excess is that those railroads existed physically, those data centers physically exist. Even if the companies fail, those places exist, those materials exist, and we're going to be able to use that no matter what, even